So one of the strategies that we use for people that aren't necessarily, I mean, entrepreneurs can do this, but sometimes we get people who are not entrepreneurs who still want to look at like how do they save money on taxes, right? And let's say they have a big W-2 or something like that. We start looking at how do you prevent income from being taxed in the first place. And interestingly, cash value of life insurance is one of those ways. So basically, the structure here is that you buy some sort of permanent life insurance product. That could be whole life, it could be universal life, it could be variable universal life, but anything but term. Term life insurance doesn't work. So you buy some sort of permanent life insurance product, and then you overfund it. So if your minimum annual payment is $5,000, you're going to put more than that in there. Maybe it's $10,000 a year, maybe it's $20,000 a year. There's a limit called a MEC limit, that the insurance company will tell you what it is. And so that's the maximum amount that you can put in each year. And so overfunding the life insurance policy does two things for you. So number one, the money that's in the policy reduces the mortality cost of the policy. So it makes the life insurance policy less expensive. And then the other thing that it does is whatever earnings are inside those permanent life insurance policies is all tax deferred earnings, right? So if you have $100,000 of cash value in a life insurance policy and it earns $5,000 of interest in any particular year, you don't pay tax on that $5,000. So that's one of the ways that we, reduce somebody's tax burden is to make it so that the income that they're earning isn't taxed. All right, so that's step one. Step two is let this cash value of the life insurance grow and compound over a long period of time. And then one of the features of cash value of life insurance is that you can borrow from that policy, whatever cash value is in that policy, and as long as you keep the policy in force, then whatever you've borrowed from the policy is not taxable to you as income. And in many, many cases, like I should say the prototype design for this is, invest, let's say $100,000 of cash value into a life insurance product, let it compound over time. And then when you're at retirement age, let's say it's got $700,000 of cash value in it. Well, that's $600,000 of growth and appreciation. That $600,000, if you just took it out and canceled the policy, would all be taxable to you. But if you borrow it from the policy and then let's say, 20 years goes by and you die, then the policy pays off the loan. None of that $600,000 is taxable to you. So it's an amazing way to invest money tax deferred and then pull money out of that contract tax-free and then have the contract just pay off the loan. Powerful, powerful strategy. So you can compound that strategy. So when we're talking about cash value of life insurance, there's let's say, more advanced move on cash value of life insurance where you buy a bigger policy, right? So because there's a limit, this MEC limit that we talked about before, there's a limit to how much cash value you can put in there. The limit is based on how much death benefit you have in the policy and how much premium you have built into the policy. And so if you want to put that whole plan on steroids, you need a bigger life insurance policy and you need a bigger premium. But a lot of people they don't have the cash flow to fund that. So banks will actually loan you money for the life insurance premium. So it's called premium finance life insurance. And what you actually pay as the person whose life is insured is just the interest on the loan. So the loan pays the premium, you pay the interest. And what ends up happening over time, depends on how this is constructed, but say 7 to 10 years, is you pay the interest on this loan. Let's say it ends up being $1 million loan and you've paid, let's say $350,000 of interest over 10 years. That $1 million loan is now translated into maybe $2 million of cash value in the life insurance contract. And now it's self-sustaining. There's enough cash value in the life insurance contract to pay the loan, either pay the loan off or carry the interest on it. And now you've got a ton of money in a life insurance contract that has a very large death benefit, and all you paid was the interest for a certain period of time. And then you can do all the things that you could do before. You can borrow back from it, you can pay off the loan, you can just let the income grow tax-free. Very powerful.